Hey guys, it's May from Markets with May, and today we're going to be discussing why aggregate supply and aggregate demand do not set the price of cryptocurrency. And I'm sure this is going to be really controversial. As many of you guys know that are daily subscribers of Markets with May, I've been working on some consulting projects that have me really deeply researching all of the crypto tokens. As a course of my research, I realized there's this nuanced point that's super important but kind of misunderstood in the white papers and also articles I was reading. To give you the punchline, it's not aggregate supply and aggregate demand that set the price of anything, no matter what asset class it is. Instead, it's the marginal buyer and marginal seller at a given point in time. And this is a very important nuanced point. I'm going to go through 4 things related to this to clearly explain both what I mean and what the problem is. First, I'm going to describe very clearly what I mean by marginal buyer, marginal seller at a given point in time. Second, I'm going to talk about aggregate supply and aggregate demand and how this whole concept is different. We're going to talk about the implications of this on the releasing and burning of tokens. And finally, we're going to talk about the capital markets function in a bank, what they do to stabilize, how that all relates to intrinsic value, which ends up being kind of an important concept when you're getting some kind of whale attack. But before we get into that, it would be amazing if you could like, share, comment below, click the subscribe button if this content is helpful to you. Additionally, I always have to give this disclosure: past performance is not indicative of future returns, nor should anything in this be implied as a suggestion to buy or sell. Let's get into why aggregate supply and aggregate demand do not set the price of a coin. Now let's define what we mean by the marginal buyer and marginal seller crossing at a particular price. Okay. Here's the thing. A lot of people are going to be like, well, isn't it just aggregate supply and aggregate demand coming in? It's not. It's actually the specific buyer who then transacts with a specific seller that creates the price. And the amount of volume has nothing to do with that. In fact, a lot of times, if you're in a semi-liquid market, this will make obvious sense because this is unfortunately your day-to-day as you try to work the market. But you'll find that the volume numbers are sometimes not truly reflective of what is actually the aggregate supply and aggregate demand. While this is accentuated in markets that are trending up aggressively or trending down aggressively, you do actually see this on the day-to-day. If you've got a consolidating marketplace, you'll see a set of volume and it'll look like, oh, this is the aggregate supply and the aggregate demand. But in fact, as soon as that thing crosses a certain threshold, magically this volume appears that didn't exist before. And that is actually the marginal buyer and seller crossing at a point. And then it's really your best try to get out of the way if you're in the wrong direction, or to get into the trade before the trade is done. So that's what we mean by marginal buyer and marginal seller setting the price, not aggregate demand and aggregate supply. Now let's talk about aggregate supply and aggregate demand and what specifically is the problem here in using supply and demand as the metrics to set a concept of market clearing price. Well, it turns out that in all the economic models that you'll see in textbooks, not on a trading desk or on a quant desk, you'll see some stationary concept of aggregate supply and aggregate demand and market clearing price. And the curve represents all these different people with different viewpoints on the price, right? That's what you'll see. And you'll be like, oh, aren't I clever as an economist? And you are, for sure. Don't get it wrong. Where it all goes terribly wrong is this assumption that I'm creating my price based on some intrinsic demand that I have. In a speculative market, both directions, I'm actually basing my price based on the fact that you have a price. And so what happens in consolidation, once it crosses over a certain point, is that I now have a new price for which I have a whole lot of volume that I would like to do. And that is how you get your face ripped off if you're in the wrong direction, or make a ton of money if you're in the right direction. Now, there are some concepts within math that do match to this. Technically, I don't think any one of these is the correct mathematical concept. Some people might use like an autocorrelation adjustment for the way that price movements move, and then they'll use some kind of heuristic to try to tweak it a bit or something like this, okay? Some people will say, no, it's a game theory, and then the certain slope, la, la, la. Okay, cool. All that math, good for you. But what I am saying is nonetheless, this concept of volume determining the price action if you asked me to chart it for you after the fact and then describe what happened. But it would be a little bit difficult to make your analysis based on the volume as it showed before it cracks, either direction. And I think anyone that trades that wants to comment below can tell you of incidences where they got their face ripped off by trying to just use existing volume metrics versus thinking in terms of something else happening. Now, the next point we're going to talk about is why it matters in crypto. Like, what's the big deal? And the big deal that you'll then see in white papers is the release of tokens. Sometimes it's just on a schedule. Sometimes it's related to any number of things. But one of the things that I saw in a lot of papers was it just being released based on price and volume demand, which I just told you, like, what actually drives volume demand in the speculative market. So you can kind of get a sense that there might be a problem here. But let's go ahead and spell it all the way out. If you are releasing tokens into speculation with the desire to dampen demand as you go, and it's the marginal buyer and marginal seller that are setting price, then when that person or that whale, it doesn't even have to be a whale to be honest, if you really look at exactly how you would set marginal price and marginal demand, you would see that you could do it with smaller amounts of capital. But I digress. All that really has to happen, according to a lot of these bonding curves, is the price goes up, possibly due to speculation, and essentially then tokens get released. And that should wash up some amount of demand. And in some cases, it's released one at a time. In other cases, it's released in batches. There's a whole different array of ways that people want to release their tokens. And that could be good if, in fact, you're able to continue that demand upwards and that demand is not speculative. What if it is speculative? In the case that it is speculative, then what we're intonating is that the marginal buyer, when they're done, unless there's another marginal buyer right behind them, you got a problem. You just released a lot of extra coins, and the value of those coins, kind of by definition as to why you released them, were released to speculators because you were trying to get them to stop buying. Now, there is a function in any big bank, investment bank in particular, on the trading desk called capital markets. And this is true of whether it's a bond, a stock, whether you're initiating a new ETF or something like that. And it would be a function that is specifically to address known periods of speculative behavior. But to make it simple, because I know a lot of people have a bit more experience with equities than, say, debt or ETF issuance or the launch of a new futures contract or something like that, let's just say it's an IPO or a secondary offering. What happens is a lot of shares come to market all at the same time. And the broker-dealer's job is to place the shares with folks that will not sell. And the manner in which they do so is primarily institutional investors and then, to a lesser extent, private investors. The way that these deals are supposed to be done, there is a book runner. That's what they're called, the book runner. Kind of sounds like a bookie because it's actually not that different, to be honest with you. But the book runner of any secondary or primary offering of shares, their job is to try to place most of the stock with what we call quality investors. And the rest of it, if there's a little bit of speculation, that's fine. And of course, sometimes it's not perfect and they place it with a bunch of people that punt the shares as soon as the deal comes out versus holding it for any kind of period of time. Now, a lot of people are under the impression that Wall Street's just a bunch of greedy dirtbags, and that may be true in some cases. But largely speaking, there is liability if you fail to do your job correctly and place the stock in a way where you don't have immediate sinking of the stock way below deal price. Yes, oftentimes initial public offerings and secondaries do dip below deal price. But when it goes crazy wrong, or sometimes you can actually look at direct public offerings to see how badly it can go when the stock is not even bothered remotely to be placed with investors that are of quality. Now, I want to describe what typically it means to be a quality investor. Quality investors will 100% hold the stock. Oftentimes, they have to present to the broker dealer what is their price target for why they're willing to hold and buy on the deal. And that will ensure them getting a slug of the stock, but not necessarily all of the stock, so that they can still be in the aftermarket, as you call it, purchasing stock. This is also true of other instruments, but it has little nuances in each and every market. But the point is that a quality investor is not just a holder, but will actively purchase it when it dips below a particular price, or in many cases, at a price that is far above what the broker dealer priced it at. Let's bring it back to crypto and why that's relevant. It's relevant because if a coin is based on a mechanism that essentially releases coins into a speculative market with the purpose of damping down demand, what's actually happened is you've released and distributed a bunch of coins to a bunch of people who absolutely are not quality investors, almost by definition. So essentially, this mechanism makes it significantly harder to balance out and stabilize the price of a token. The volume that you're releasing is sometimes greater than the volume you initially placed with quality investors. And now you've got to try to fight against them by burning tokens, if you can do it fast enough, which usually you can't if you look at the shape of some of these bonding curves, or somehow hoping that someone that you know really supports the token has enough capital to buy it. Now, the problem with assuming that you've got quality investors that are going to come in and buy it is that they'll buy it at the point in time at which that thing is falling. But no one typically steps in to catch a falling knife. It's still their cash money. So they'll probably wait a little bit once the knife has started to fall aggressively until there's some point at which it really makes sense for them to accumulate more. But in the case of tokens and in the case of crypto, there better be some concept of intrinsic value, because if not, it's even hard for someone to step in and be helpful. I really want to reiterate that this is not every crypto token out there. And in fact, some of the ones that most absolutely understand it are the ones where you're seeing visibly a lot of whales and fish schools, or whatever you want to call it these days, coming in and supporting the coin. That said, for every one of those, there are maybe more than one that have not thought about this correctly and did not understand this aspect of supply and demand, if you will, or marginal buyer or marginal seller. I also want to reiterate that it's not just this dynamic that's causing the crypto winter in a couple of different tokens, particularly those that went from several $billion in token cap to zero in the course of a couple of days. Instead, that does have a bit to do with collateral, of which, with that issue combined with this issue, you really do have a velocity to these coins that can really escalate quickly. That's all I got prepared for this episode. If you enjoyed this content or found it helpful, please do leave a comment below, like, share, subscribe to my station. Always helps me know what to make for all of you. And until next time, good luck in these markets.